the Bank of England has implemented a third quarter-point interest rate cut within the past 6 months, bringing borrowing costs to their lowest point since June 2023. This decisive action reflects growing anxieties surrounding the UK's economic trajectory and presents significant challenges for Chancellor Rachel Reeves. The move, largely anticipated by financial markets, which assigned a 97% probability to a rate reduction, follows the unexpectedly positive inflation figures released last month. December's inflation rate registered at 2.5%, a slight decrease from November's 2.6%, offering a glimmer of hope amidst prevailing economic uncertainty. This downward trend in inflation marks a significant shift from the peak of over 11% obs. This surge was largely attributed to the dramatic spike in energy prices triggered by Russia's invasion of Ukraine, which sent shockwaves through global energy markets and exacerbated inflationary pressures worldwide. In response to this initial inflationary surge, the Bank of England aggressively raised interest rates, reaching a peak of 5.25%. However, recognizing the evolving economic landscape and the potential for a significant economic downturn, the bank reversed course, implementing 2 previous interest rate cuts last year, the most recent occurring in November. The timing of this latest rate cut adds another layer of complexity to the already precarious position of Chancellor Reeves. Earlier this month, Reeves faced intense scrutiny as a rise in government borrowing costs, fueled by prolonged expectations of higher interest rates in both the UK and the US, prompted concerns that she might be compelled to breach her predefined fiscal rules. These elevated borrowing costs represent a substantial financial burden for the government, potentially limiting its ability to implement crucial economic policies and social programs. The increased cost of government borrowing directly impacts the nation's fiscal health and could necessitate difficult choices regarding public spending. The heightened uncertainty surrounding the UK's economic future was reflected in the market's reaction to the rising yields on 10-year government bonds, which essentially represent the interest rate the government pays on its long-term debt. These yields serve as a key indicator of investor confidence and risk perception. The increase in yields fueled concerns about the government's fiscal sustainability and its ability to manage its debt obligations. However, in a positive development, the yield on 10-year government bonds has since retreated to mid-December levels, offering some temporary respite and suggesting a degree of market stabilization. This recent stabilization, however, does not eliminate the underlying economic risks and challenges faced by the UK economy. The Bank of England's decision to cut interest rates further highlights the delicate balancing act the government must undertake to navigate these turbulent economic waters. Further details regarding the implications of this rate cut and its potential impact on various sectors of the UK economy are expected to be released soon. The ongoing situation necessitates close monitoring and analysis as the economic outlook remains uncertain.